state that the overbought condition on the short-term trend, being overbought on 10 days, is not a reason to be concerned here, because it can stay overbought for a long period of time, particularly since we're young in the life cycle of this potential bull. And so that could last another 4 to 6 weeks for sure, just based on the fact that we're in bull quiet. We haven't reached 137 yet, which is still the last year's high that we have to get through. But all things really point to the upside right here, with all of these indicators favoring the bull. It has resisted the reasons to fail and is continuing to march forward, so all that is reasons to celebrate the long side. And moving on. Just taking a quick look now at the blended monthly rebalancings. This is not only a tradable system, but it also gives a pretty good indication of where the strength is in the market. We'll see that reflected in the world market model. But this is a pretty good proxy for that as well. Treasury is still at the end of a pretty good long 6 to 9 month run here, even though we observe that it just crossed under its 4-month moving average, and so that's the only member of the 13 portfolio that is not on a buy signal. And then you can see that it's U.S. large cap mature companies, the old reliables, DIA. And then interesting to me is that we have this stealth move here in Latin America. We would see EWZ high on the list. We'll see that down here in the 26 portfolio too. But Brazil and Latin America, I think, are benefiting from a stealth bull that is emerging in the U.S., and I believe Latin America and Brazil are benefiting from that emerging market effect, in that they're a growth story, they're commodities based, and so they're going to do well as inflation continues to stealthily increase, and they're not Europe or Asia. And so I think that's where the growth story is right now, is Latin America and Brazil. So if you're interested in the growth story overseas, that's the place to be. And then we have U.S. Small caps also at the top of the list, doing better than the mid caps and the large caps and technology. And that is, again, sort of a stealth. I would consider that to be a stealth growth play. So we see those things now starting to emerge. So it's U.S. small caps, Latin America, and Brazil, while treasuries cool off, and I think that's money rotating from treasuries after a historically excellent run, starting to cycle into the growth stories. That's U.S. small caps and then Latin America, Brazil. The rest of the U.S. now picks up, the midpoints here, U.S. real estate, spiders and mid caps and technology, and then the laggards remain in the rest of the large cap globals, Asia less Japan, the Euro-Asia blend, Japan, and so forth. And you'll see that same trend expressed across the 26 ETF portfolio. With the interesting one to me down here is agriculture, because I think that's I'm waiting to see that bottom out and wait for inflation to start starting to rear its head back in the agriculture sector. So that's to me, this may be a winter. It's the winter in agriculture, but its day will come, so I'll be watching for that to emerge out of the bottom as well. But otherwise, up top here, what we have are the growth stories: Brazil, diamonds, Latin America, Russell small caps, Treasury starting to fade. And again, most everything is on a buy signal except for Treasuries. Gold is taking a breather. And then Swiss franc and agriculture at the bottom. Otherwise, this is a stealth bull starting to emerge. And again, with ADX still under 20, just remember it's come out, ADX, the measure of trendiness, got as low as 10 and is now strengthened back to 18. But it doesn't start getting stale until SPY is up above 30. So there's still reason to believe that we're in the early innings of a potential bull developing in the U.S. and Latin America here. So we're entitled to believe in a to have a long orientation right now. And so we'll now shift over to the market health check and see what we can see. And this reflects kind of the same story graphically. So what we have are the vertical blue lines represent 10, 20, and 30 days of look-back period. The solid red lines, again, are, as always, the support levels that have held before. And the dashed purple lines represent the price targets where resistance is to be expected. So right now, we have emerged from above the last support level, broke through that last week, and holding steady. And our new target is about 137, which is another 3 to 4% where we are going to bounce into resistance, potential resistance zone from last year's swing high. Now, we've been saying that since April of last year. March and April was when we hit 137. And it has knocked on that door a couple times, but never been able to break through. What I really like about this intermediate term trend, let me clean this up a little bit, is what I like is that after the dip at the end of December, which could have been some tax selling, I suppose, we've had this generally gentle upward slope start to emerge. You can see the regression line is tilting up. You can see that the slope of that regression line on the indicator has been up considerably. It's still positive. It's getting to a level where it was in the last upsurge that we had. I like the higher lows. I like the higher highs. I love the declining volatility. I like the fact that we've been overbought for 3 weeks now and haven't really threatened to come out of that overbought. So it can stay overbought for a long period of time, and I still think that's favorable. I see our resistance, though, in about 3 or 4%, and that's where this young tactical bull is going to be challenged to see if it really has the strength to go. If it gets through 137 after 1 or 2 knocks on the door, once it gets above 137, a close above 137 is going to be very bullish, and will sort of be confirmation that what we have here is not an oscillating market, but actually the beginnings of a bull. So I like the fact, again, bull quiet. ADX is clearly pointing towards increasing bullish trend. The bulls are in charge. The volatility has declined dramatically. If you think back to August of last year on that sharp sell-off, ATR percentage in SPY was around 3.5% per day. It's now down to 1%. So 2/3 of the volatility has been squeezed out of this U.S. market, and you can see that reflected in the march upward here. So we have price better than the 10-day moving average, better than the 50, better than the 200. And right now, as soon as that red line comes out of the shaded blue area, what we're going to have is the iron cross. When the 50-day moving average crosses the 200, we're right at that condition right now. That's going to that will give a positive confirmation to conservative institutional money, which is looking to bet this bull, and that would be the fourth mouse, if you will, getting ready to jump in. So we're already long and postured on the long side. This looks very favorable. What's the downside price targets? Looking at those red lines, if we get failure here, if the breakthrough at 137 doesn't occur, then what we'd be looking for in the downside is profit targets, 129, 127, 125, and then back to the 200-day moving average. That's really the galactic boundary right now on the downside. So if we're concerned as tactical traders, the channel looks to me right now to be about from 125, excuse me, which represents about a 8 to 10% pullback from the high at 137. I'm looking at 137 to 125. That's a 12-point range. That's a 10% move. So right now it's in the upper half of that, but we do have some tactical buffer on the downside, and all those dips are buyable. So if it shows resistance here with this doji and then starts pulling back and then stabilizes and start to go up, as long as that's above 125, That's just tactical noise, and you can buy those dips. That's why systems like the channeling system, the long side overreaction system, the 551W, the triple screens, all of those tactical swing trade system signals should be paid attention to and enjoyed. You should be buying those dips and getting larger on the upside. Okay, moving on. Taking a look at the ETF2 summary, what we have is all 10 of the large indexes on buy signals based on that 4-month moving average filter, and that gets us to 100% exposure. Right now, the U.S. is still better than the rest of the world. We're in a bull quiet market. It's the U.S., technology, then small caps and mid caps. The two strongest remain SPY and the Qs. Although I see that the mid caps and the small caps have really closed the gap, and then with just a little bit more strength, I expect those growth stories in here in the small caps and the mid caps to start taking over. And you can see that on a strength basis, they have already started to bypass SPY and MDY. So it'll only take about one more week of upside for them to take the lead inside the U.S., and that's really the risk-on trade. That's the growth trade. The weakest ones remain Japan and their debt load, and Europe with their debt load, and there's no way that's going to change anytime soon. So this is really kind of a make your hay in the U.S. and Latin America while it's there to be made. Moving on. Taking a look at the world market model now. We have the U.S. is completely above average, and small cap value really leading the way here. That's the growth story. Asia less Japan, generally below average, but doing better than Europe, which is mostly red. You can see Mexico, Brazil, and Latin America starting to emerge, starting to lead the way there. And in the business sectors, what you're seeing is a shift now away from those defensive sectors of staples, utilities, and healthcare, and more towards the business sectors, tech, finance, energy, industrials, and that has not been the case for the last 6 months. So if this was going to just be a sideways oscillating market, you'd have seen those defensive sectors continue to thrive. But now we're seeing a shift more towards the engines of the economy, materials, finance, industrials, and tech. So I think that favors the growth side as well. Oil and gold still above average. Silver's made a nice run. We're going to take a look at that opportunity. Some folks in the chat room were able to get on top of that one after the last sell-off in December and cash some nice coin in silver. So we'll take a look at that chart. It's back to what I would think of as fair value. I think the easy money in silver is over again. Long term, though, I still love it. Still love that silver. Moving on. Taking a look at the ETF top 30. This is out of the 500 ones in the ETF database, looking at the average ranking, and still dominated by the interest earning, treasuries and bonds and so forth. But what we're starting to see is the growth stories. Biotech, semiconductors. The Wisdom Tree Dividend Top 100 is still a good play. Small cap value, IJS is the way to play that strength that we saw from the world market model, where the U.S. small cap value was really winning. That's how you play that little macro trend is IJS. Utilities. Dividend payers, dividend leaders, diamonds, retailers, healthcare, consumer staples. So you can see in the land of equities, with that exception of that biotech, everything is still favoring the U.S., still favoring dividend earners. These are guys with proven business models and are making money as we speak. So that's still the global trend that we're looking at. Moving on. This is a new report. I think I put some text on it in the weekend report, but I think this is the first time since I've been doing this report that I've actually had a chance to talk about it on the weekend webinar, so I'll just hit that briefly. I basically took the Dow 30 and the ETF 30 and dumped them into a separate database. And now instead of using the 500 ETFs, I'm using that same structured approach and then concentrating just on the ETF 30 and the Dow 30 to come up with these numbers. And it's using exactly the same methodology to come up with the average strength, consistency, and quality. And then this report simply takes the Dow 30 and it filters out the ETF 30. So it gives you a sense of the Dow 30 strength. And I'm sorting this by strength column because that's really what I'm interested in, is the current relative strength in the Dow. And by having the ETF 30 in there, it gives us a wider set of reference indexes to compare. So we can see even the weakest member of the Dow 30 right now, which is Alcoa, which has a strength of 33 and an average of 33 and a strength rating of 51. That strength rating of 51 says even the weakest member of the Dow is at the 50th percentile when you consider the world economy. So that really tells you that everything in the Dow is dominating. And then that gives you the ability to look at what's really dominating. So maybe the top 5 or 10. These are the guys that are really kicking butt right now. Pfizer, Caterpillar, Merck, Cisco, Home Depot. Longtime favorite McDonald's, still good. Kraft. So right now, that's if you want to drill down into companies but retain the safety of large cap and dividend earners. This is a report that gets you into those and then shows you where the current strength is. Because I specialize in the Dow 30, I really like this report. I should have done it years and years ago, but there we are. And so right now, only the treasuries are. I must have I'm sorry. I have to convert that back to AT&T. Everything in the Dow right now is on a buy signal. This was just, I think, a goof to put TLT in instead of T. I was testing something, forgot to fix the symbol. Glad I caught that. But in general, the large-scale news here is that everything in the Dow is dominating. The weakest member of the Dow, Alcoa, is still very strong compared to the rest of the world, and that's good news for the U.S. So there's that report. That's the new report. Moving on. I'm going to shift just to the daily report now. Let me pull that up. All right, no change to the top row here, so I'm going to shift right to the gap statistic, and basically what we're looking at here is that volatility has really begun to diminish. Even the gap statistic itself has gotten smaller. The standard deviation is now under 1%, and in August of last year that was 2.5%. So the volatility intraday, the volatility on a monthly and a swing basis, and even the volatility of the gap itself has declined. Now, you can see that the market has been overbought and stayed that way using the 10-day NDX. Not surprising in a young bull. The overreaction system has some short side signals in the emerging market areas, the global areas here. And so I want to comment just on that. Euro-Asia blend, Asia less Japan, emerging markets, and Europe. Now, because what we have is a emerging bull, led by the U.S., it's pulling the rest of the equity markets up. And that causes the conditions whereby these weak indexes, the weak global indexes, have also started to respond to that. But because they're still under their 200-day moving average, that fires short rules in the overreaction system. Now, here's how I play that. I do not automatically take those signals the next day simply because the light flashed. Because we're in bull quiet mode, what I will do is I will target those as the weakest indexes, and then if I see weakness in the U.S. market, then I'm pretty sure that there's going to be weakness in those. Then and only then will I start piling on those on the short side intraday. And then if the market closes weakly in the lowest part of its range for that day, I'm willing to hold that position overnight. Now, if this was a bear market, I would be taking those short side signals immediately. But because the market tendency right now is to be up, I will simply identify these as my candidate targets for the short side and then play them only if there is weakness in the broader market. And then if I do, I'll find which one of those four is the weakest and then look to pile on that on the short side. So this is a bit of a tactical refinement where I'm using market conditions and the research that I've just been talking about for the last 20 minutes and use that to refine my target list on the short side. So that's the strategy. You can see the daily pivots just for reference. I pay attention to 131.47 in the U.S. and then because I trade small caps in the futures, I'm looking at this column here for IWM with about, and you can see that even R3 and S3 are within a buck of IWM, and that means a very, very tight channel indeed. So you got to respect how much volatility has really come out of this market, and why the initial stops that might have been 80 cents or $1, 2 months ago now can be 25 cents simply because the lack of volatility. Now, what wouldn't surprise me is if this bull quiet market got shocked and went to the downside. I actually, on an intraday basis, am very excited about the potential for short side trades on one-day pullbacks. Those can be sharp volatility spikes, and so the surprise big gains to me are available on the downside, and that's where I'm looking for those weak targets in the globals to really make some hay if we get weakness. Okay, so let me go a little further now. All right, taking a look at the pen trades then and some of the other charts in here, you can see just how much volatility has pulled out of this market. It's gone from almost 3.5% ATR percentage now down to right at 1%. That's a reduction in volatility in the last 2 months of 67%. 2/3 of the volatility has come out of that market, and now you can see that the ADX is starting to climb up. And in that same period of time, when volatility is declining, it's the bulls starting to make their case. So once again, more evidence that volatility is inversely related to market gains. So if you're on the long side, volatility is not your friend. And this is why paying attention to that volatility indicator can be so powerful. It can give you a heads up on which side of the market to be in. So during the tactical trading of the last couple months, this volatility indicator has suggested that, hey, pay attention to the long side, and so swing trading has been rewarded. Take a look at the 10-day min and max pain. The minimum pain tells you which ones have been dominating: J.P. Morgan, Microsoft, Travelers, ExxonMobil, and then in the Dow, it's on the short side, or the weakest ones have been Disney, Coke, Home Depot, and then Chevron. VIX and natural gas have been extraordinary losers. The natural gas story has just been crushing people with long-term beliefs on that one. Wow. What we have is channeling signals. That should be USO, not USI. Pardon my typo. and then 551W in utilities. Moving on. On the pattern trades and the Dow summary, we have a number of dojis, but really no pattern trades per se, because I think Thursday and Friday were so quiet last week. Max Payne candidates are ones that I'd be paying attention to here: Disney, Chevron, Coke. And then if you take a look at that, they've only lost 1% from their 10-day high, from their price of 10 days ago. And so that's really not much. Even the Max Payne candidates are not in much pain. Chevron is of interest here because now the auto framer reward to risk ratio is 3.2. Now this is a new column, I think, since the last time we did the weekend report. So let me just describe that. I've added a new column now to the Dow 30 and the ETF 30 tactical report. And what I've done here is I've computed basically a mechanical end-of-day trade and said, look, independent of any signal that you might see out in here, if we just took the 10-day high and yesterday's low, and if we bought the mechanical entry, what would be the reward to risk ratio if we just did that, playing a return to the 10-day high? In other words, mechanical, that was yesterday's price candle, and if we bought the mechanical entry at 5 cents above and we used yesterday's low as the 1R, and then we played for a trade to the 10-day high, what is this reward compared to that 1 day of risk? And then that's the ratio. Now, if any of those in the Dow or in the next chart, the ETF, come in at better than 2 to 1, to me that's a tradable opportunity, particularly if it's a Max Payne range compression. So I'm interested in Chevron on that basis because it offers a 3 to 1 reward to risk just using this stylistic trade frame. I think of this as trade location. Where is it inside that 10-day band? And if there's a favorable reward to risk, I'm willing to trade momentum on that basis, even though there is no formal structured pattern that's set up. So this is almost an additional 1-day opportunity trade, and it's based off the auto framer reward to risk ratio. And then if we take a look at, let me move up now to the ETF report. You'll see the same technique expressed there. And now this is what becomes very interesting on the ETFs. We have some channeling signals in oil, treasuries, and utilities. So you can see the channeling trade. And all of those are Max Payne range compression. And they all have a favorable reward to risk ratio using the auto framer. And now these are all, I would observe to you that these are all contrarian positions that the money's been going into the equities. But if we see that stall next week, then these defensive plays ought to do pretty well. And in that case, I would like the defensive play of the utilities because that's a 551W pattern. It's a channeling pattern. You can see it's a Max Payne range compression, and it's a 2 to 1 reward to risk ratio. And so although it's not sexy, it does represent a very favorable trade frame. I like the fact that the VIX has gotten crushed because of that decline in volatility. And again, as a tactical trader, I'm prepared for 1-day sharp pull-offs or pullbacks in that market. And so I'm not surprised there. I also like silver. Just as a tactical trader, it's had a nice run. It's done better than gold. It's pulled back above 31. We highlighted it as an opportunity at the end of December when it got down on a sharp sell-off at 26. And so that's been a 20% move from the time we observed that anomaly to get back up to 31. That support level at 30 still remains important. And in fact, when it violated that, that's when we started really stalking it more carefully. So that's silver. And also lots of dojis, and you're going to get that when there's a decline in volatility and the market feels fairly well priced. You're going to see a lot of dojis. Now, let me just give you a highlight. Just on these last two reports, one of our friends in Australia, Mike Dungy, has been using exclusively this kind of general strategy, looking at trade locations. He's been pulling 1 to 2 R a week by just concentrating on the Australian 20, the ASX 20, and his favorite mining stocks. And he just is paying attention to reward to risk ratios for his favored stable of horses there, the ASX 20 and the miners. And just by managing reward to risk, making careful entries and locking in profits, and not taking excessive overnight risk, he's been consistently pulling 1 to 2 R a week out since the October workshop where we went over some of these ideas. So there's a lot to be said for just paying attention to trade location and developing expertise with a handful of favored targets. And that's essentially what I'm trying to do myself with the ETF 30 and the Dow 30 tactical summary. So I have patterns that I'm very fond of. There's a built-in reward to risk ratio. There are these relative price changes in the Tortoise NDX to tell me where they are on trade location over the last time periods. The idea of highlighting the exceptional performers using red and green flashing lights. And there's money to be made in there just on the inefficiency of the market as those large caps get back and fill and whatnot, and there's room to be made inside these routine oscillations. So just to keep that in mind, the power of specializing and staying flexible. Moving on. In the frog quality report, it's still nice to see that there are still quite a lot of favored targets that are still above 3.0 on the frog quality numbers, so that's a good thing. And a lot of those are reliable trading vehicles in there. I'm always paying attention to natural gas intraday. The standard deviation is so small that you can take one-day trading profits inside there. Oh, let me see. I'm sorry, Lisa had a question here. I just noticed. What I mean by a one-day opportunity is this. The market is bull quiet and everything is marching northward, and volatility is declining. And so if that truth stays the same, one-day opportunity to me is piling on an intraday position where I'm already long because of a swing trade, and then adding to it, going turbo, and then taking off the turbo piece to hold my overnight risk constant. That's a one-day opportunity to take advantage of continuation of the upward trend. The other opportunity is to find those weak targets that we saw in the global ETFs and the VIX, and that if we get one-day sharp pullbacks in a bull market, which is normal, is to have those already prepared for one-day intraday anti-trend trades, because the downside move will be a shock. It will be more volatile than the upward move, and so I want to know where the weakest sectors and the weakest targets are so I can take advantage of a one-day pullback in this young bull. But I have no belief in the overnight trade on those, because then I'd be fighting the longer-term trend. So in that case, what I'm actually doing is identifying one-day intraday trends that I can ride, and then to get to cash in those before the overnight. So it's a one-day intraday opportunity. So that's what I mean by one-day opportunity. Okay, moving on. I want to go straight in the last few minutes here. went a little longer on the trend discussions. I want to just jump straight over to some representative trades in the 551W, and just to show you what kind of patterns that rascal will have. And these were all patterns from last week. There we go. All right, so this was a sample trade, a trade frame in Disney. Let's see if I can make that a little bigger for you. There we go. So this is Disney has been a strong member of the Dow, and what we had here was in December and November, this oscillation had support here at 33. And then the pullback, it was like a triple bottom here, and then it started this long run up. And the first indication that it was no longer oscillating was at this critical moment when it came back to the 50, and it didn't fail. Didn't fail here, but instead had a big candle up. That was very powerful. Then when it breaks through the 200 and breaks this double top, now suddenly what we have is a change in market psychology. We no longer have this oscillating within this band, where we had 1, 2, 3 pullbacks to 33. Now what it does is it comes back and then only gets to the halfway line, finds support, and then breaks out on a big bar. Has a doji to consolidate and then breaks out above the 200 and keeps going. So and then the next little pullback, it didn't give back anything, and then breaks out again. So what we have now looks to me like another new block. This looks like a Darvis block to me. And what you have now is a 551W pattern on this day, which I framed in the following way. That we would automatically buy at 39.05 with the stop a nickel below, targeting looks like about 41, which gives us about anywhere from a 2 or 3 to 1 reward to risk ratio in something that has now generally been trending upward. What I want you to see is how that 50 period moving average slope is now very favorable, whereas it was sideways over here. It now starts to reflect this bull market. So this is sort of a very low risk entry on a 551W. It's up for 5 weeks. It was down compared to 5 days ago, and then had 1 day of positive gains, and then you can buy the second day momentum, and it's favorable because you have a 2 to 1 reward to risk. So that's the beauty of that 551. It's like a lazy man's triple screen in that sense. You get to up and to the right. So that's what the trade frame for that day 551W looks like. A terrific pattern to trade in this kind of creeping, grinding young bull up. Same idea now in Procter & Gamble. So this is Procter & Gamble. And again, you can see after the December sell-off, it gets up and above. It does not fail back below the 50 and the 200, but instead keeps going up. Another nice measured pullback, finds support. This was actually a 551W that day. It fired another signal that day as well. And if actually, that's 3 551Ws in a row would have fired. And so very favorable. You can set a profit target about 67. What I like is the fact that it's got 1, 2, 3 higher lows. This up and to the right, this is sort of that panda move up. Lazy W's up to the right, buying dips in bullish markets, and then you still have favorable reward to risk. So 551W helps you find those nicely. One of my favorite patterns in a quiet bull. Chevron, this is also from the middle of last week. Again, you can see that up and to the right, and we still have a very favorable trade frame here. We'd just be playing for the test of the swing high and then using yesterday's low as the risk. You can see that there's a 2-to-1 reward to risk ratio on that frame. Would have also fired on the channeling system earlier. And I think there's one more in the stack. Let's see what we can find. Yeah, Coca-Cola, an excellent one from last week. Had a nice measured pullback from 70 down to 66.5, but you can see we had this long up and to the right. It held support where it held support before, held support again, and we'd be willing to buy at 67.55, looks like, or 67.70. And then I've set in 3 potential profit targets. Any one of those would have been a favorable one-day move, one that would have allowed us to cash some gains. So 551W features this generally 5 weeks up. It's higher today than where it was 5 weeks ago. It's lower than where it was 5 days ago, so there's the measured pullback. And then we had 1 day of favorable price action, and then we're looking to buy the second day of momentum. So again, that's the essence of 551W. It's a very powerful pattern in a young bull market that's going to feature like channeling and lazy W behavior. It's a very relaxed way to get into powerful moves, and it gets framed in the usual way. So that's everything I wanted to cover for tonight. So I'll let you guys get back to the football game, and I got some more writing to do. I'll go ahead and process this file, upload it to YouTube, so you can, if you feel compelled to listen to this again, the sound of my voice, you'll be able to do so. So I'll hang around for a couple more minutes of questions. Otherwise, good trading, and we'll see you in the chat room, and see you again next week.